Hey, what's going on, everybody? Welcome to The Tax Life. I am your host, Jeffrey White, tax professional, 30 plus years of tax experience. Um, Welcome to The Tax Life, and welcome to this session, which we're going to talk about the three pillars of taxation. We're going to talk about income, deductions, and credits. But first, I got a question from a viewer in an email last week, and they asked me how I got started in taxes. And it started a long time ago, about 31 years ago, and I got started as a way to feel like I was being productive. At the time, I had quit my job in Los Angeles. I was a financial investment planner, and I wanted to start a business. And I started a business with my college roommate, and we started a trucking business. Yeah, I had a college degree and an advanced degree, an MBA, and but I wanted to be a business owner. I wanted to be um, uh, in control, if you will, of my destiny. So my roommate in college and I, we always talked about going into business together. We didn't know what kind of business we want to get into, but we wanted to do a business that would, what we considered, made money and help people at the same time. What we got into was trucking, and it wasn't typical trucking like on the road, over the road, long haul, that kind of thing. It was construction trucking, and I had no idea of how to drive a truck, but my partner taught me how to drive a truck, and I learned how to drive a truck, and I would go start drive with him all day, and come home and be dirty and grimy because in construction trucking you're working with a lot of materials, a lot of dirt, a lot of rocks and uh, tar and things like that, and asphalt. So I was feeling a little bit unfulfilled because I had all these advanced degrees, and I wanted to be able to utilize that. So I saw an ad in a magazine. Was a magazine that was magazines were back then, and it was about learning how to do taxes, H&R Block. So in the evenings after I got through driving, I would go to H&R Block, and on the weekends, and learned how to prepare taxes. I enjoyed it quite a bit. I felt good about it, and this was in California, in the what they call the Bay Area of California, and I eventually was offered a position, and I took that position. My first position, believe it or not, was in a Sears. And I know I'm dating myself for a lot of you guys, but some of you guys do remember Sears. And Sears used to have a basement, and the H&R Block was in the basement of this particular Sears in Hayward, California. And that was my first experience. I really enjoyed it. They gave me a lot of the easy tax returns. This was before the internet was really high powered. So it would take a couple of days for a tax return to be acknowledged after it was e-filed, and you go away and come back maybe the next day or the day after that, and then find out it was acknowledged and accepted by the IRS. And now, as today, it could take a matter of seconds before you find out after you e-file whether a tax return was accepted. But I worked in an H&R Block for 6 years. I worked in the Bay Area of California, and then also in Southern California. The first 3 years, just prepare, and then the second 3 years, I worked there for 6 years. The second 3 years, they offered me a position to teach the class, and that began my education and my instruction and my teaching of taxes as a discipline, and I've been enjoying it ever since. So just kind of give you a little background. That's the first part of the story. It's been a 30 plus year journey to get where I am today, but just so that you have a good idea and understanding of how things started, it's an interesting story, and we'll talk more about it as we go along. So to get tonight started, three pillars of taxation: income, deductions, and credits. Let's talk about what a pillar is, because I can say the word, but if we don't understand what it means, then you kind of loses its strength. But a pillar is defined as a structure or an apparatus that is reliable, and it is a structure that is providing essential support. So when you take the idea of a pillar and then move it into taxation, and we talk about these three pillars that we're going to talk about tonight: income, deductions, and credits. You can kind of see how they are the foundation of every tax return, whether it's a personal tax return or a business tax return. You're going to have income, you're going to have deductions, and sometimes deductions, let's say on a business return, are called expenses, and then you're going to also have credits. And credits happen on business returns as well as personal returns. Tonight we're going to kind of focus in on personal returns, but just know that the credits are actually even powerful, more powerful on business return. So let's talk about the first pillar, income. Now, taxes can sometimes seem like a maze, right? And the idea of a maze is that you're put in there, and there's all these limitations and all these barriers that you cross, but you have to go from one part of the maze to the other part. You go into the maze, and then you find your way through to get to the outside of the maze and to what we might call freedom. So taxes can seem like a maze to some people, but obviously the more you understand it and the more of the foundation you have in knowing about that maze, if you will, then the better tax life you're going to have. So that's what we're kind of trying to do with these sessions. We're going to talk about your tax life from A to Z, and the three pillars we're talking about. Income, that first one, is the foundation, and the IRS defines income as any property, any money, any fees, any goods, any services that you are compensated for. They consider that income, and you need to think of income as the flow, if you will, of your wealth through your life, or the ability to have flow through income. And the idea is income is a tool. We want to remember that will be able for you to use that tool to make your life and others' lives more enjoyable for the time that we have here on this planet. So there are two types of income that the IRS recognizes when it comes to tax returns in general. And according to the IRS, they recognize earned income and unearned income. So let's talk about earned income first. Earned income is what most of us are familiar with. Things like your wages that you get, your hourly wage, your salary that you might get, where tips that you might receive if you work in the hospitality industry, or what a lot of us are familiar with is self-employment income. This is your business income, whether it's a sole proprietorship, or whether it's a partnership, or an S corporation, or a corporation, or just a side hustle. But business self-employment income is considered earned income because you actually have to, in most cases, physically do something to earn it and to receive it. So the government and the IRS will see that as a taxable earned income. Now, the other income that they recognize is unearned income. And this income is when the money that you make from your earnings, you take that money and you invest that money, and then that money that you work for starts to work for you. You invest that money in things like the stock market, and the stock market can produce money for you in the way of dividends, which are going to be monies that are received at the end of a corporate year or a business year, and there are profits, and those profits are going to be divided up to the shareholders, because those are what the dividends are. You could receive money, unearned income, in the way of interest, like bank CD interest or interest from money market accounts. There is other earned income like rental income. Rental income is not earned income. It's unearned income because you're taking your money, you're purchasing an investment, say like a single family home or a multifamily home. You're taking your money that you earned, and you're investing that money, and then that money, by way of that asset that you have, makes money for you. It could be a rental property that's on a lease, a year-to-year kind of lease, or it could be a rental property that is used in a lot of tax planning, a property that's short-term rentals, like things like Airbnb or Vrbo, okay? And then there's also capital gains, which is unearned income, and that capital gains, again, comes from investment of your money into a stock, and then that stock either appreciates in value, and then you sell that stock, and you make a gain, which is called a capital gain, on the difference between what you bought the stock for and what you sold it for. All right, so those are some examples of unearned income. So when you look at income, you got unearned income and earned income, but then you also have what the IRS likes to talk about, and those are taxable income and non-taxable income. So you got income you earn from working, you got income you earn from investing. Now we have to look at those two types of income and what of those two are taxable and what of those two are non-taxable. So let's talk about the taxable income. And taxable income is primarily a lot of the earned income, like the wages and the dividends and rental income and interest. But then there's also non-taxable income. This is the income that you might receive, but the government doesn't look at it and does not tax it. Some things like some gifts that you might receive, in some cases inheritance gifts are non-taxable. Life insurance is a big non-taxable income, okay? And then some payouts, and then even some scholarships that students might receive, excuse me, are considered non-taxable income. Why is this important to know the different types of income? Well, when you talk about different types of income, you want to be able to plan for it, okay? I'll give you an example. We have a client right now that we do some tax planning for, but when that client first came to us, he had just started getting into the investment community and started investing in rental property, and he had made a couple years worth of income off of the property, but he wasn't necessarily happy with how his tax situation, his tax life, if you will, was working out. So he was referred to us, he came to us, and we immediately saw some things that we could help him with, but he was really concerned about the money that he was making on his rental and his taxation. So the rental income happened to be unearned income because he didn't actually work for it. Remember, it was money that he invested and bought that property, and then that money, that investment was making money for him. So it was unearned income, but it produced taxable income in the way of $18,000 per year in rents. So he wasn't happy with how the situation was working out. He was referred to us. We take a look at his situation. We took a look at his prior year tax returns. We took a look at his future goals and dreams through a questionnaire that we had to have him go over. And then we were able to identify through a strategy, a tactic that we use, a tax tactic called depreciation. And using that particular tactic, we were able to save him $10,000, and his taxable income out of that initial $18,000 went all the way down to $8,000. So every year for the last couple of years, we're using that tactic along with some other strategies, and we're able to save him $10,000 a year. Now, why is this important? Why is it important to know the types of income? Why is it important to know earned income, or unearned income, taxable versus non-taxable? Well, I believe that it's important because I believe that you can't manage what you don't measure. Okay, what that means is that when you're planning your taxes and you know the types of income that you're going to have moving forward, in your tax life, when you can plan for them and strategically plan and then implement specific tactics that are geared toward leveraging the tax laws that are applicable to your situation, then you know how to plan better, plan smarter, and in this particular case, we're saving our client a lot of money every year. So it's really important to know about income and the types of income and being able to plan for it strategically. So I got a question for you. Have you ever wondered whether you or whoever's preparing your return, have you ever wondered if they're preparing and calculating and reporting your income correctly? If you ever wondered that, just go ahead and leave me a comment, and we can talk about that a little later. All right. The second pillar in taxation is deductions. Okay, so what are deductions? Well, deductions are what the IRS says is they lower your taxable income and they reduce the amount of taxes you have to pay. So if you just look at the word deduction, and you can kind of go with its root word would be to deduce or reduce, you're going to reduce the amount of income that you're taxed on by using a tax deduction. Okay, and the IRS even has certain tax deductions that they will indirectly reward taxpayers and business owners in providing deductions for them for performing and doing and having certain behaviors. An example would be saving in a retirement plan, or buying a home, or charitable donations. When you put money in a savings plan and save for retirement, the IRS in some plans will reward you indirectly by allowing you to put that money that you're going to put in a tax savings plan, let's say like a 401k or an IRA, they'll allow you to put that money in that plan tax-free, that's before taxes. So you have a situation where you're going to get a potential tax deduction because it's going to lower the amount of income that you're taxed on, because it's not counted against you because it's deducted from your income before it's taxed. And then on top of that, in a lot of plans, they will allow you to accumulate the money that you make from unearned income, like interest or dividends on those retirement plans, saving plans, tax-free until you pull that money out. So it's not a direct reward per se, it's an indirect reward, but it also incentivizes behaviors like putting money aside for retirement, like buying a home, and this works for rental homes or your personal homes, but you are still allowed to take a deduction for mortgage interest that you pay, and then also charitable contributions. And obviously charitable contributions are really valuable because they allow you to proactively plan for your tax life through cash donations to different organizations or non-cash donations. But the idea is that you have a lot of control on what the final result is when you take those deductions. Okay, so there are two types of deductions that are, two types of deductions that every taxpayer has at their disposal. The main tax deduction that a lot of us are familiar with is the standard deduction. And standard deduction is available to every taxpayer based on what's called your filing status. Okay, and your filing status is what your marital status is at the end of that calendar year that you're going to be taxed on. So there are 5 filing statuses. There's single, there is married filing joint, there's head of household, there is married filing separate, and then there's qualifying widower or widow or widower. Okay, and these 5 filing statuses have dollar amounts associated with them. Every year the dollar amount increases, and I think the government will increase the standard deduction incrementally, a lot of times based on the cost of living that is projected to go up in the United States. So it increases usually every year, but it's a standard amount of dollars that you can deduct immediately based on your filing status every year. And obviously, if your filing status changes, then your deduction amount changes, and each filing status has a different dollar amount that you can deduct associated with it. And what we'll probably do is, probably in another session, we'll go over and have a session specifically designed to teach you guys about the 5 filing statuses, how they work. But just know that automatically, based on your filing status, every year you're going to get a certain amount of income deducted from your taxable income. Now, that's given to you, and that's a no-brainer. It doesn't take any thought to actually take that. That number comes from the government. The other type of deduction is called an itemized deduction. Now, this is where tax planning really has an advantage, because an itemized deduction is specific deductions for certain expenses that you will cover, that you will incur over the course of the year. Some examples of those expenses would be medical expenses, state and local taxes, real estate taxes on your home, or real estate taxes on your rental property. It could be mortgage interest that you pay on your home loan, charitable contributions, and then there are other miscellaneous deductions. There were a lot more prior to 2018, but they were written out. They're actually scheduled to come back this year. We don't know if some of those itemized deductions will be brought back into the system because of the new president. But without saying that, you take these individual expenses, and then you take the total of them, and that comprises your itemized deduction number. Now, you don't have any control over the standard deduction because that's given to you based on your filing status. I mean, and no one wants to control their filing status, and go from single to married just to get a higher deduction. That's not advised. But you have the ability to somewhat control your itemized deduction, and the goal would be to take all those individual items, you're calculating them together as a total number, but to make those numbers as high as possible to the ability in which you have to control them. An example would be, you have the total and utmost ability to control your charitable contributions by donating to qualified charities, either in cash or non-cash. That's a number that you can control, thus controlling how big your deduction would be when you itemize. Okay, so those are the two main deductions that are going to show up on every tax return. As part of a good plan, you would probably want to strategize and decide how and when and how and if you could get to a point where your itemized deductions would be greater than your standard deduction. That's a strategy that I'm going to give you right there. But every taxpayer should actually plan and do some strategic thinking in regards to, how do I control that element of my tax life and strategize to get that itemized number higher than the standard number. Okay. Give an example. Tell you a story. We get referrals all the time, and we love referrals. And we had a taxpayer that came to us, and again, I want to say in this particular case, they were unhappy with their tax life, the final numbers that came from their tax life. So we took a look at this client. He's a single tax filer, and we took a look at his tax return, and matter of fact, the last 3 years of his taxes, and he filed standard, took the standard deduction, filed on time. He earned about $50,000 a year. He took the standard deduction, and everything was fine. But he was just wondering if, is there something that he could do to make his in numbers better, meaning save more money on his taxes? So after we took a look at his situation, we realized, hey, in all those years that we looked at, he was just taking a standard deduction. And so we did a thorough interview and started asking him about his tax life and what was going on in each one of those years. And did the person that was helping him with his taxes actually talk to him and see if it was possible to take the standard deduction number and increase it by itemizing his deductions. And to our surprise, well, not really to our surprise, because this happens more than you think, the person that was doing his taxes never really asked him about those things that he could possibly itemize, was taking a standard deduction. Wasn't a lot of conversation, there wasn't a lot of planning, there wasn't a lot of preparation, if you will, in putting the return together prior to when he dropped off his documents to get done. So it was pretty much a no-brainer. Hey, we talked to this client, we started to ask him, okay, what's your typical year like? What are some of the things that you have? Why don't we see this on your tax return? Why don't we see that? And then we were able to determine that in, I think, 2 of those 3 years, and going forward with proper planning, of course, in 2 of those 3 years, we were able to get the proper documentation and move him into a position where he would be able to take the itemized deduction versus standard deduction, which would save them a few $1,000s every year. And then going forward, after we started working with him, we positioned him so that every year, with his control and our guidance, he would be able to itemize his deductions versus take the standard deduction, thus increasing, in his case, his refund a few $1,000s every year. So that's an example of why it's important to know about things like deductions, because it's a pivotal thing. And if you can and have the ability to control something in your tax life, then why wouldn't you do it? I mean, what do we learn from this? Preparation leads to opportunity, okay? And because there was not a lot of intention on this particular taxpayer's tax life, then there was no ability to take advantage of opportunities. And so we just uncovered the opportunities. We began proposing to him to be intentional in his tax life, and from then on, there was a change in his tax life monetarily, and then with that, he's able to meet whatever goals and dreams he has for the future a lot easier and a lot sooner, because there's a little bit more money in his pocket every year. Okay, so let me ask you a question. If you're not planning your tax life, how do you know that you're getting the most out of and the most of your deductions? If you're not planning, if you're not being intentional about it, and there's a lot of us that aren't, there's a lot of you that aren't being intentional, and that's what this is all about. This is all about raising your attention so that you can become intentional and disrupt your tax life to the point where you shake it up and you start to be more thoughtful about how this is going to work for you in your tax life. So, just something to think about. All right, the final pillar that we're going to talk about is tax credits, or credits as they're commonly known. And credits are one of the most powerful tools in the IRS tax code. And credits work really, really good for both personal tax returns and business tax returns, okay? Because credits are a dollar for dollar reduction in your tax bill. So the way it works is let's just say you do your taxes or someone does your taxes, and there are different parts of a tax return where you have to reconcile numbers, right? And you might have subtotals, if you will, okay? So there's a part of the tax return where there's a subtotal that calculates what your tax bill is, okay? That's how much you owe. But that's not the end of the tax return. That's just a subtotal. But that subtotal is designed to let you know where you are at that moment or that time or that position of the tax return. You got the subtotal that tells you what your tax is. Okay. Now you know what your tax is. Let's say your tax bill is $10,000, and that's what you owe at the time. But now here comes credits, and credits come along. And remember, credits are dollar for dollar deduction, or I don't use the word deduct, but it's a dollar for dollar minimization of your tax bill. So if you got a tax bill of $10,000 and you got tax credits of $5,000, that $5,000 worth of credits reduces now your tax bill down to $5,000. So you can see how powerful that is, because all the calculations of all your income and deductions are done, and now we're just trying to see what you owe. But here comes credits, and the more credits you have, the lower your tax bill will go and be. As a matter of fact, that leads us to the next point, which talks about the types of credits, okay? And IRS really loves credits because credits are also a way of offering them as incentives to do certain things, especially in the business world, okay? And that's the IRS way of indirectly saying, here, thanks for being a good citizen, thanks for running a good business, thanks for providing for the economic stability of our society, we're going to give you some credits. And then the hope is that credit lowers your tax bill, or that credit adds to your income in some cases, and then you use that to stimulate the economy by buying goods and services. So in a second we'll talk about that with an example. So two types of credit. This is great stuff, right? There are refundable credits and non-refundable credits, okay? Refundable credits, I mean, you can listen to that word and go refundable, refund, okay? So a refundable credit works in ways that once you have utilized all of your credit to pay down your tax bill, whatever credit that is left over after you get to zero now comes to you in the form of a refund, i.e. refundable credit, right? An example, let me give you an example. So the American Opportunity Credit, which is a credit for when you go to college and you got 4 years to use this credit, and the credit is what's called a twofold credit. Kind of jumping the gun a little bit, but the credit has a double utilization. Let's say you can utilize it or maximize it in two different ways, right? So you get a credit for going to college and paying for college, certain portions of college on your own, and the first part of the credit is a credit that eats away at whatever tax that you have. So your tax bill is calculated, and you come up with a number, let's say $2,500, right? And your tax bill is $2,500. Well, just so happened that the American Opportunity Credit is $2,500. But that first $2,500, that first, let's say your bill ends up being $1,500. So out of that $2,500 credit, $1,500 of that credit goes to pay your bill down to zero. Okay, so now that $1,500 tax bill is down to zero. You've used $1,500 of the $2,500 credit, and then that $1,000 that's left, because it's a refundable credit, now goes to be a part of your refund as $1,000. Okay, that's how a refundable credit works. Now, a non-refundable credit is basically what I just said earlier, but it's just a dollar for dollar minusing of your tax bill. So if you have a non-refundable credit and you qualify and are eligible for a specific non-refundable credit, then what happens is you have a tax bill, let's say $10,000. As a matter of fact, there's a credit that is given to businesses nowadays, and they're hoping that it's going to be reinstated, because I think it's scheduled to phase out, but it's called the Qualified Business Income Credit. And small businesses that make income and have a profit, they automatically get a 20% credit on that profit, and that credit is a dollar for dollar credit based on the tax bill that comes as a result of those taxes. So business has a profit, let's say the business profit is, I don't know, 50,000, and their tax bill is 20,000, no, that's too high, 10,000, then the QBI 20% will be 10,000. So that 10,000 will now be wiped out or brought down to zero, because the 20% QBI tax credit is exactly the amount that is the tax that is incurred on that business. So again, non-refundable credit, there's no money that comes back to the taxpayer or the business owner, but it will reduce your tax bill dollar for dollar, and those credits in that particular case are one of the benefits or perks, if you will. Some people even mistakenly call them loopholes, but these are one of the advantages that a business has, let's say, over a taxpayer. Now, taxpayers do have certain credits that businesses don't have, but the idea is that the government will really likes to promote credits for businesses, because a business can utilize the money that they get from not paying taxes and take that money and reinvest it in their business. And the government likes businesses because businesses employ people, and the government doesn't want to employ people or pay people. They just want to collect. They don't really want to pay, but they want the private sector to do that. So that's an example of a non-refundable credit, and that's why the government likes non-refundable credits, especially when it comes to businesses, okay? So again, credits are what some people might say a secret weapon for the government, and credits are given to individual taxpayers. They're given less and less over the years. In my 30 years that I've been a tax professional, they've been kind of taking some away over the years, but businesses are still really highly promoted to and have a lot of tax credits that are available to them, and a lot of deductions as well. Okay, so what do we learn from tax credits? Okay, credits are a secret weapon that the government used to incentivize and basically reward people and businesses. And then the hope is that if the credit is a refundable credit, that the money that is refunded to a taxpayer or even a business is utilized to put back into the economy and keep the economy stimulated, and our society productive, and above certain levels of poverty, but also to incentivize businesses to invest in new equipment and new services, and reinvest in their business to keep the economy strong. Okay, and that's why they call the credits the secret weapon of the government. All right, but planning and utilization of credits are super important, and you need to really be mindful of looking for those credits that you qualify for, because they obviously can drastically reduce your tax bill, and in some cases produce refunds that can come back to you as well. Okay, question: if you're not planning, how do you know if you're maximizing the credits that you may be entitled to? How do you know what credits you're eligible for? That's a good question. If you're not planning, then you may be missing out. Okay. All right. So let's recap. All right. Let's talk about what we discussed. We covered the 3 pillars of taxation, Again, a pillar is something that is steady and reliable and provides support, okay? And the pillars we talked about, income, deductions, and credits, we talked about how they do provide that support. They support the individual taxpayer, they support businesses, they support our society. But if you do not know what they are, or if you're not working with somebody that does not know what they are, or if you're not positioned to take advantage of them, then they're of no good to you. But income is the foundation. Without income and money, our society comes to a halt. Okay, so it's the foundation. Then you have deductions. Deductions lower your taxable income, because we now know that not all income is taxable. You can actually get income that isn't taxable. Okay, and the goal of any tax plan is to lower your taxable income, lower your tax bill, and then lower what you pay to the government. And then finally, there are credits, and credits are powerful in a sense that they reduce your tax bill, and then a reduction of the tax bill in your tax life should spur some thought about taking that savings and doing something that either promotes your tax life going forward, or promotes one of your goals financially, or one of your personal dreams. But the idea should be conceptually to take that savings and make your other lives better, your family life, your retirement life, your business life better, because of those credits and the savings of those dollars, and then those dollars are reinvested back in your other lives. Okay, they're foundational. The pillars are foundational, and they're examples of, when properly thought through, you can leverage them and impact your financial life, have empowerment, and plan for the future, and affect yourself and your family and your children and your children's children maybe, and society, and thus that's why those pillars are important. Okay, action items, things that I want you guys to take with you. Understanding your income sources and being able to understand the implications of those sources and how they affect your tax life. I want you to take with you, you need to track your expenses and record them properly and diligently, and then also maximize your deductions. Okay? And then finally, I want you to make sure that you or whoever's doing your taxes claim all the credits that you're eligible for to keep more money in your pocket. But then also think about the ability to position yourself or your tax life in a way that if there are credits that are out there, if you position yourself in your tax life properly, then you can take advantage of that. And in a lot of cases, unless you do some deep dives and some study, you're not going to know that, and that's why you go to a professional, but a professional that approaches tax lives in a holistic viewpoint, a holistic way, and not just one aspect of it, say like tax preparation. All right? So I got a question somebody asked: is unemployment compensation considered earned income? Unemployment is considered taxable income. That's the first thing, okay? And it is considered unearned income, okay? Because unearned income, again, is money that is paid to you from, in most cases, things that your money makes money for you. Your money buys an investment. In this particular case, in most states, unemployment compensation is paid for by the state, but it's paid for by insurance. Okay, and in most cases, the insurance is collected from the taxpayer when the taxpayer receives income from working. In a lot of cases, the government takes a itty bitty portion of the income that taxpayers make, and they put it into a pool, and they put it into a fund, and that pool or that fund is where people draw down to get unemployment compensation or unemployment benefits. So because it's a type of insurance, and it's not income that you made or are receiving for physical work, even though you worked physically indirectly, but it's not directly from the work that you did. That's the reason why it's not considered earned income. Now, it is considered taxable income, and in most cases, it's taxed at the income rate, like other income, like other W-2 wages or salaries. Income is taxed at that same rate. It was a little bit different during COVID, and there was a particular year, I want to say maybe 2020, 2021, I forget, but that one year that I want to say 20 because that was probably the most drastic year for COVID-19, but the government put into place after the tax year had started that they were going to only tax the first 10,000 of they were going to not tax the first 10,000 of income from unemployment sources, and then the remainder they were going to tax. And they were doing that as a benefit to the society, trying to give people a tax break, trying to stir the economy. But yeah, to answer your question, unemployment compensation is considered unearned income, and it is taxable. All right? So great question. I appreciate that. I'm looking forward to a lot more questions. I'm looking forward to a lot more people viewing this. But I'm going to do what I am, what's the word I'm looking for? I'm going to do this because I believe this is part of my purpose, and all these years of this knowledge that I received, I got to be able to pass it on and move it forward, and share, if you will, what I have to offer. And this is the expertise in my tax life. Okay, so thank you so much. I appreciate you guys viewing. I'll see you next time here on Tax Life. This is Jeffrey White asking you, what's your dream?